Hello and welcome to uh, today's stream. And today, I'm just going to be looking at some financial statements. On a Sunday, it wasn't not a productive Sunday. Didn't do many of the things I set out or I should do. Um, yeah, but today, just going to be looking at financial statements. Uh, the three financial statements, of course, are the income statement, balance sheet, and cash flow statement. Of course, the three financial statements. So if you're ever taking accounting 101, hopefully some of these, hopefully this can in your tertiary memory come in to help you. Personally, I have been looking at Weibo. Um, has been interesting because I was looking at Tencent. I was looking at Tencent's evaluation or multiple, and the way Cap IQ does it is that Cap IQ. Uh, let's see if I can. Okay, so the way Cap IQ does it uh, is that Cap IQ shows like it's a professional financial level, not piece of software, but data source. And what it does, actually let me take a screenshot. Let me let me take a screenshot to illustrate the point. Give me a second as I switch to another tab. Actually, it is a good thing I'm switching to another tab. Uh, okay, here we are, and onto the whiteboard. All right. So Cap IQ, okay, I guess yeah. Today this is like educational. We can look at this. The Cap IQ, right? It has a lot of different things. For example, it makes it very easy, as they say here, to download uh, the income statements and a bunch of really helpful tools and data. And so Cap IQ really helpful. Costs a lot of money. Like I actually got in contact with one of their sales reps because I was curious because like I have access to it through my university but I won't, I'll graduate in a couple years. So, but Cap IQ is such a useful tool, and the Cap IQ, you know, it costs like the cheapest is 24K subscription. So, but which is unfortunate because Cap IQ is really nice. There is another tool ticker tikr.com. It's similar for like user interface and like purpose and like functionality, but I'm not sure if like the numbers add up and that and it's yeah not equivalent to Cap IQ, right? Uh, but anyways, let's get into this. So anyways, so thinking about why I'm doing this today, why I was interested. I was looking at Tencent originally, but then I saw Weibo. So I was looking at Tencent, I was looking at their trading multiple. But then I was just looking through, right? Just seeing what Cap IQ thinks, what the industry thinks that like next, right? There's LTM, and then there's NTM, which is okay. So LTM. Apologies for that. Okay, so LTM, last 12 months. NTM, next 12 months. And of course, the thing about projections, right, is that you don't know what it, if your projection is actually correct, right? Nobody knows. Now, of course, you do know what your last 12 months were because it's all in the past. You filed your statements, posted your filings, had your earnings call, all that stuff. Uh, But next 12 months, isn't known. And something I've noticed, at least on Cap IQ, is that a lot of the earnings estimates moving forward are pretty lofty, like expecting like 30% EBITDA growth and going in. But we know that it's not the case if like all these, especially some large companies, are cutting back spending. So I'm not sure how much credit I put into into that. So anyway, I was doing that just because like if okay, let me go to okay, let me send it another screenshot real quick then uh of the trading multiples. Okay, right, right, and so like okay, focusing on Tencent again. So just because it says that Tencent's forward earnings is 21.98x for again next 12 months, right? Just because it says that doesn't mean it's actually the case or actually realistic that that is the case. Because what if it's expecting what if because what if EPS last 12 months and not real numbers actually we do know uh, Tencent okay, so we know so Tencent last 12 months uh, we know from 3.06 in US dollars, right? We know last 12 months. Okay. But okay. And so that informs and Tencent's trading at $40, so it's uh like it's like 14 yeah, but it's at 41 $42. It's like at 14x earnings last 12 months, right? 14 right. But what if so but the estimates for EPS next 12 months currently uh, I don't know what it is, but it's whatever it is gets you to 21.98. And now, okay, and so what if EPS is $5 or what? So what if so like the idea of like why I take you have to I'm diligent in checking the earnings estimate to then like to back out the number is because you can't just the projection like going from $3 to $5 when of EPS earnings per share. Well, is it possible? Sure, but it does seem a bit lofty. Yeah, and would I prefer to bake in some margin of safety personally? Uh, yeah, and so maybe I don't buy whatever higher EPS number to get you to 21 or 22 times earnings. Maybe I go to what if I stick at the same EPS, or what if I only add like, from $3.06 to $3.50 as my next 12-month EPS. So it's just backing it out. Um, so, anyways, that's kind of cute and kind of like the entire idea of like what for if you hear people talk about forward earnings, uh, forward enterprise value to EBITDA. I'm not gonna talk about sales as that's not the most relevant figure, but but there's that idea, right? Um, so that core concept. So I was looking at uh, Tencent just because I do have a position in since 2020, so it's one of my longest positions. So it's my Tencent child is 2 years old. Uh, it's just getting set up for my next tangent. But yeah, 2 years old. So I've held Tencent for a while. Added more shares. Haven't so 2020 Tencent. Uh, and you can do the math. I'm sure of you can look at the chart. But anyways, so I was looking at Tencent, but then I noticed right here, if we zoom in, I was looking. There's tangible book value per share. Tangible book value per share. Uh, and what tangible book value per share I'm gonna use Investopedia to tell me. Uh, Pretty much it's you have a share price and you have your tangible book value per share. And tangible book value per share is like how much of a company's assets is each share entitled to. So theoretically, if a company decided to pull up and leave and just liquidate, you as a shareholder would get this much uh, theoretically. Of course, there's like imperfections and like, but it's a proxy. but it captures the idea that you as a shareholder are entitled uh, as a shareholder to this much of the company's assets. That is what how much of the company's assets is beholden to your share. Because right, all a share is ownership of a company. Again, stocks are slices in a company. Just as like Lee Lu or Warren Buffett would remind you, you're buying a stake of a business. You're not buying a share price. You're buying a stake in a business. But anyway, so I saw this. I mean, look at Tencent. So Tencent, $9, $9 a share, uh, $9 a share in book value per share. But this, uh, but 41 bucks. So so theoretically, like you're not getting a lot of value. But then I noticed Weibo. Um, Weibo, $19 a share, 14 bucks in book value. Of course, there is the caveat that right, this is Investopedia. Um, Book value is not necessarily the most useful because it's only for like tech companies because our tech companies it's you don't have say a whole lot of like inventory. You don't have whole like say if you're like a manufacturing company. If you're a manufacturing company, you probably have a lot of stuff in your factories, in your warehouse. You have some tractors, you have some parts, maybe you supply, so you have a bunch of wrenches, maybe and of course you have cash and treasuries or short-term investments or those things, cash equivalents. Um, and we can just look at like the balance sheet of a company where you see cash equivalents, accounts receivable. It's money that you should receive in the future. Um, Investments. And the point, and so to quickly summarize, the reason I decided to look into the balance sheets of Weibo, I just figured Tencent because you have to talk about Tencent because I think Tencent and the balance sheet, Tencent and its long-term investments is just I think interesting to watch, to look at. But anyway, so I just want to take a look at Weibo's balance sheet right, because if theoretically you're entitled to 14 bucks a share, and and it's the stock's trading at 19, that theoretically like the price to book is like just above 1x price to book for a tech company that theoretically it has reasonable prospects. Again, I'm not sure if we'll look into the 20F Weibo's 20F its annual report which lays out like what the business is, its risk factors. Actually, I can't pull up what it looks like. Again, not necessarily gonna look at it because it's a 346 page document. Um, Not sure how how interesting it would be. Again, I'm working through it myself because I'm not the most familiar with Weibo. Like I feel like I have a more intuitive understanding of Tencent. Certainly, given how Tencent gets talked about a lot more, I use WeChat. Weibo, I'm trying to set up an account. It's a bit tough if you don't have a Chinese SIM card to set up a Weibo account, set up a Douyin account, much to my chagrin, because there's some really cool Douyin accounts that I would really like to follow and watch. But anyways, and of course this will go into more detail in there about their 20F. Normally it's a 10K. Uh, Normally it's a 10K for US based companies, but because Weibo isn't domiciled in the US or whatnot, right? Cayman Islands, China, uh, or foreign companies don't use like the 10K, 8K. They use like a 20F, like F format. Uh, Here we are. that's in thousands. I like millions better. Easier for my simple brain to understand. I'm just so used to millions that like, gosh, adding in three extra zeros will mess me up. Uh, but anyways, so yeah, so it's gonna so with that prelude, right? So quickly summarizing, we have book value per share, of course, and it's pretty much the company's how much of the company's assets are you entitled to with one share. Uh, and again, right? So if Joy decided to liquidate, you would theoretically make money, right? Uh, if Ziff decides to liquidate, theoretically you wouldn't make anything, right? But of course, right? Again, the value of the book value depends on what the company's assets actually are. Um, if it's an intangible, right? Like I suppose you can liquidate the cash somehow, but it's not whatever the carrying book value on the balance sheet doesn't translate perfectly then, right? And so maybe so pretty much the point is because like Weibo is a tech company, maybe this $13 figure isn't the all that accurate or helpful, right? And so anyways, and so what we're gonna do, again, I'm not, I took some accounting classes at my university, but I'm definitely not a uh, financial statement expert, so I don't want to expose myself. I don't want to humiliate myself, and certainly this isn't anything expert, but it is pretty much like just gonna look out like what these line items are and just talk about what they are conceptually and like is it an intangible like so pretty much right so book value is like total assets of company. And so pretty much my idea is how much of this number is like is something I can expect or depend on versus an intangible which I can't necessarily depend on as much. Um, right. And so pretty much the idea is to figure out like how accurate this book value is. And so what then you can do, I can then like come to my own number. So CapIQ says that the total assets are 7.5 billion US dollars total assets. And so what I can do, I can I can subtract, say like maybe I don't I don't believe in intangibles. I don't think goodwill. I'm not going to count that in my book value calculation. So I can subtract those out, and so that'll put me to about 77.3 billion, and then I can divide 7.3 billion by total number of shares outstanding. And uh, I can figure out total number of shares outstanding, um, which for Weibo is 148, and I can just divide out 7.3 billion divided by 148 million and get a more accurate book value number, or not to get a more accurate book value number, but just to see like how much confidence I should actually place in this $13.91 a share in book value figure. And just at a quick glance, I do think I can reasonably trust in that figure. I would say. And so real quickly, all right. So the book value per share, you can't you can't take it at you have to or you should ideally do some digging into it just to in general it's not doesn't hurt you to look at a balance sheet or income statement or any of the financial statements. uh, but also then but yeah just because it is a tech company, so who knows if the assets are how they are. Not that the assets are counted incorrectly, but how much is like a hard asset that you can count on versus something like a goodwill that doesn't necessarily have like a cash uh, a tangible cash thing that like can count towards your theoretical like liquidation redemption figure. And also then, towards the end, to make things interesting, because of course Tencent is the evil boogeyman of companies, and then we can look at so also when as Tencent buys ownership, I'm pretty sure that goes under long-term investments because your assets have to show up somewhere. and owning something, or at least I'm not sure about the companies they own outright, like Supercell or Riot Games, which they own 100%. Or Riot Games is like not 100% because like the employees have equity, but but right, so it's not like a publicly traded thing. So I'm not sure where it goes. I'm pretty sure for like equity stakes, it's it shows up in long-term investments. So it'll just be fun to see like insane uh, value appreciation of those assets. But anyway, let's look at Weibo first. So cash is king. Short-term investments, these could be in treasuries, these could be in short-term bonds. Uh, I don't know, maybe certificates of deposit. I'm not sure if companies would invest in those versus bonds, but okay. So 3 billion of so cash is cash, right? And you know what? If cash isn't cash because of fiat currency or whatever, then that's a whole nother discussion of a whole lot more problems, right? So pretty much all this cash, right? I can take it face value. Now, what I should do, honestly, what I should do, if I should like have a side calculation, I should be like subtracting that from this just to get a running count, and then I could actually do like the actual division a calculation, but I am on a guest tab. I don't want to expose my search history, my the websites I visit, and that sounds wrong, but don't want to. I was looking at my IRS account, downloading some tax files. You know, prefer to segue that. Um, that was a bad segue. Yeah, don't want to expose the companies, the investor relations pages of companies that I visit, because of course genius ideas over here, um, or the embarrassing Investopedia articles that I read as a me, a Target School student, reading Investopedia articles to fill in the stuff I forgot from Accounting 101 and Finance 100. Um, so yeah, apologies for not having like the actual calculations. It would be fun to flex some Excel skills to hear the nice typing of of a of a keyboard. But anyways, okay, so 3 billion cash. Yeah, again, like so at least in my view. So and what line items of a balance sheet that you personally take seriously? Of course, the great thing about investing, right, is like there is no objective truth beyond, of course, like the share price of a company. But there's so much nuance and uh, intersectionality when it comes to evaluating things, and so I think to me that's an interesting thing. And so of course you can differ, and so please in the comments and in the chat if you have a different view, if maybe I should like discount short-term investments to some like by whatever figure, then like let me know if I should, if you think so. Accounts receivable, um, it would probably be better for me to. I know the definite. Like first of all, I know what the definition is, but I don't want to provide anybody else a bad definition. So funds customers owe your company for products or services that have been received. Now the difference, you can't, to recognize revenue, you have to provide a good or service and you have to receive the payment. And sometimes, right, like you provide the good and service, but you don't receive the payment, and that's what accounts receivable is. Um, so again, it's pretty much, I guess for accounts receivable, you probably should, like, academically speaking, you should discount accounts receivable to some degree, academically. But for these purpose, and again, price to book, like no one, I don't think anybody looks at the price to book and the share price and like does some arbitrage, right? Because like no, the company's not gonna liquidate it. This isn't like the 80s of like of of gosh, what was it? Like robber barons, Wall Street Raiders. This isn't the day of Wall Street Raiders. Like those days are gone. No one's gonna be buying out majority shareholder, majority ownership and liquidating. Um, so okay, so and this is all current assets, right? So all of this is current assets. Um, prepaid expenses, right? So you've already paid for the expense, so you're not. That's not going to be. You've already paid for the cash outflow, so you don't have to worry about that. Other current assets, yeah, not quite sure. Okay, so it's like 60-70% of the total assets that went into that price to book calculation. I'd say I'm very confident in, and so yeah, I'm feeling okay about this number. So well, let's just assume that's six. So what's I know for sure $7 of that price to book. I feel confident about. All right, and onto long term. And okay, and so those are current assets, and then there's long term assets. Just as there's current liabilities, and then there's like long term liabilities. And so long term, right? Like it's like isn't as immediate, right? Just by the name, right? Short term, long term, right? Long term, of course, being over a year. I'm not sure. And so right, so it's less liquid. So and this is kind of where you why you scrutinize these things in the first place. Again, idea. Okay, and so long term uh, PP&E, right? So like in like the poor factory example I used, but Jim Hatter's spec isn't the best example. Um, okay, so this is like physical things the company owns. Of course, depreciation is the loss in value of something of a physical good over time. Um, okay, but PP&E, plus minus whatever percent, sure, you could probably sell office chairs. Um, again, it's a proxy. It's just like capturing the idea of like what it is. Okay, so fair enough. You have this much. The value of those physical assets has gone down over time, depreciated. Fair enough. Uh, I guess we're not getting into amortization, which is the same idea but for non-physical assets, right? So if the you own a tractor and in 5 years, like, and so the value of the tractor, right, goes down, right, because it's used wear and tear, like that's depreciation. Whereas for an intangible asset, amortization, that's the principle. Long-term investments, Weibo, if you do look at the 10K, they do have like a venture capital. Uh, so they do have some investments, and certainly for other companies. Not sure if that comprises the entire uh, 1.6 billion line item. But fair enough, right? You know, assets are assets. Goodwill and intangibles. So this is where it's goodwill. Goodwill is interesting. So goodwill, again, doing it so I don't mislead any of you guys, is a portion of the asset purchase price that's higher than the sum of the net fair value of the value of all the assets purchased. Um, and because of this, so it's intangible. So it's not necessarily. It's more of an accounting thing to make the assets equals to make assets equals liability plus shareholders equity. The wonderful accounting formula balance out. This is more so like to make your and a wonderful accounting abstraction to make the assets equal liability plus shareholder equity. Has to balance out. If it's not balancing out, you missed something or something's wrong with your Intuit QuickBooks or whatever. Um, and so right, like you have to balance it out because like if you spend X amount in cash and you get X amount of cash in the other company's assets, but there's a discrepancy, then you can't have that discrepancy. It has to should be somewhere in the liabilities and the equity. Um, if anything, yeah, if anything, it just doesn't hurt to know the accounting formula in general, right? Maybe you're talking to somebody who's cool and you want to impress them. Hey, shoot your shot, right? Okay, because hey, with the accounting formula, because hey, how many people know the accounting formula, right? Probably, but not everybody, right? So, accounting flex. Yeah. Okay, but again, so goodwill, it's not necessarily a real, at least in my mind. It's and in the fact in the fact of my accounting 101 class and like focus on it too much makes me think that it's more makes me think that it's less of a like. Does this mean the company has 130 million in cash sitting there? No, it's more no. It's more of an accounting figure to make your things balance, make your assets equals liability and the equity balance out. Okay, so 130 million, bad asset. Loans, other intangibles, again the same way I didn't really get into other receivables. I will get into that. Presumably, I think it's something that would manifest, would be a footnote. Let's find a footnote. It'd be like a footnote somewhere of the financial statements. Um, oh, and that is something else. And that is why it is good to read like the company's formal like annual report filings because you get to see what the line items are. You get to see how things are reconciled. Whereas uh, with like, oh, this is like quicker and like much more information dense. You do miss out on that context, which is why so it is nice to look at the not only just like the more like information dense, but also like the actual filings themselves. Okay, long loans receivable long term, it's a loan, right? Just as it's one of the things you can expect on. Well, I guess yeah, there's always default, but you know, not gonna think too much about that. Long term deferred tax assets. Right, maybe we had losses. Maybe we have some tax credit. Maybe um, I'm not the most familiar with China's tax code. So, but again, tax asset. It means that you will pay less tax in moving forward because you either A, pay more taxes in the past, or B, you have some like credit or something that reduce your tax liability. And over long-term assets, again, not quite sure. Okay, so pretty much again, so the only thing to me that really like is like book value. I won't, again, maybe if you're a CFA holder, you might be laughing at me. But the only thing I'm not quite a fan of is this 130. But hey, so the rest of it, seven of the 7,300, 7.3 billion of assets, I buy. I'm okay with. And hey, okay, so maybe in my mind, again, in my view, everybody else can have. So maybe, again, maybe some people be more granular and like they'll discount accounts receivable, they'll discount like long-term investments, they'll like discount and reduce the value of it in their mind. But again, just for me, maybe I'm like a glass half full type of guy. Maybe had something good to eat for lunch. Maybe I'm just in a good mood, and so I'll be optimistic. Um, so is in my view is the 13.91 bucks a share the most accurate book value? No, because in my mind it's off by 130 million of that 7.5 billion pie. Um, but and so what? It's 13 bucks a share, whatever, right? So that's kind of hopefully that's a bit illustrative of like at least my process, just like at least of like what book value is, right? It's what the total value of the company's assets and minus liabilities and all that. Or maybe it's not minus liabilities. Don't want to say that. Uh, of course, I can verify very quickly. Book value equity. Okay, yeah, because it does incorporate liabilities. I guess we should look at liabilities then. Okay, right, but again, like really quickly to the accounting formula point, 7519 total assets, total liabilities and equity, 7519.5. Assets equals liability plus shareholders' equity, 7519 equals 7519. Like, bazinga. Congrats. The math works out. Good job. Okay, and so because book value incorporates liabilities as well, long-term debt, 1.5 billion. See, the problem is like at least in my mind, like if it's a liability, like you can't just write off a liability. You can't like add because you can't like ignore a liability and like you can ignore goodwill. I think it's like Maybe not everybody does it, but I think like if you talk to somebody about it, like they can understand why you would ignore goodwill. I don't think if you talk to anybody, you can just like I don't think this unearned revenue uh, counts as liability. I'm just gonna write off that 91 million in unearned revenue. Like no, that's not it's liability. So like in the sense of like what you have to take seriously versus other. And then again, right? Like if the company has like 2.4 billion in cash, I don't think anybody's really gonna say just 2.4 billion in the U.S. dollars or renminbi isn't valid. Get that out if you're. But again, so just the general idea. And accounts payable, accrued expense, long-term debt. Yeah, I can't get out of that. Income tax against like your tax liability concept, uh, unearned revenue, current liabilities, right? So that okay, right? Just compare current assets to current liabilities. 4.8 billion, 2.1 billion. Okay, so well capitalized company, right? So it's not going to go bankrupt, not be able to meet its responsibilities. Long-term debt, leases, well, 3.8. So what, just under 4 billion net assets. Okay, and then you divide that out by shares outstanding. Okay, so shares outstanding. Wait, 236. Somebody's messed up. I'm more inclined to think that Wall Street Journal messed up somewhere. I'll have to verify that. But anyway, so that's the idea, right? So and you can so pretty much like if you want, so again like you can't really like a liability is liability. You can't really dance around that fact. But assets are assets, but some assets, not all assets are equal. Is the idea? Not all assets are equal. Verify your uh, I messed up. So not okay. Not all assets are equal. Verify your uh, personal book value. Uh, Goodbye, Wall Street Raiders. Okay. So pretty much, yeah. If anything you get out of this video, not all assets are created equal. Verify your personal book value. Assets minus liabilities. Yeah, okay, and so because of doing that exercise, I do have confidence in this. Again, not 13.91 specifically, right? Because I wrote off 130 million of goodwill, but out of 7.5 billion, that's pretty close to it. All right, and so is again it is what doesn't mean I'll buy it just because the book value is like. Am I gonna buy Joy because the book value is 15 bucks higher than the share price? No, because there's more to it. It's not a scuttlebutt investing. It's not a again right like it's not like you're gonna be everything's gonna be liquidated right just because you bought a share. Uh, so there's that. Um and okay, so that's Weibo. That's the first part. 39 minutes. Thank you for sticking around. Thank you for watching. Hopefully you learn again. Anything you take away, not all assets are created equal. So verify your own definition and idea of book value. Uh, right. Okay. And really quickly, let's look at Tencent. Right. Tencent, the evil boogeyman. I suppose. Yeah. Again, I disagree with that summation, but to each their own. But yeah, Tencent. But the idea, like they do have investments in a lot of different things. You can just look at the balance sheet: 42, 53, 64, 109, 123 billion dollars of long-term investments in various companies, startups, etc. For a nice 253 billion in total assets. If we look at the enterprise value, I've talked about enterprise value before. I don't really want to talk about enterprise value today, um, but I'll type out the formula. And this is a simple formula of enterprise value. It's not the most detailed, but it's a market, or I guess equity value. Be simple. Market cap plus cash minus debt. And there's more ways you could be more specific about it when it comes to what you want to include as cash, what you want to include as debt, right? Like so, maybe only current assets, maybe only long term, including long term. You get to choose. Um, um, yeah, and you see the difference, right? Market cap, enterprise value, two distinct things, right? So you subtract. Oh, I messed that up. God. Oh gosh. I messed that up. Market cap, subtract cash, add debt. Gosh, I messed that up. But wait, did I mess it up? I did mess. Yeah. Um, market cap plus debt minus cash. Gosh, oh my gosh, plus plus debt. Oh my gosh, I'm just again, yeah, to embarrassing myself. Anyways, okay, wait, two distinct things, right? So it was Tencent. So pretty much, yeah, lots of investments. Okay, and yeah, I'm not gonna go into like. So we looked at the balance sheet today. Not necessarily gonna look at the income statement, cash flow, and most of these things are like income statement financials. But yeah, I guess it would be just out of fun, like just compare, like look at Tencent, $88 billion in revenue in 2021, 88 billion. Weibo, 2 billion. Right. So again, Tencent, it's a big boy. Um, I suppose there's some currency fluctuation, but yeah, but hey, if anything you learned today, again, if anything, if you see a cute accountant person, maybe you can hit him up with the accounting formula. Maybe not the enterprise value formula. So I may have misled you initially, but you but you can check out the accounting formula. Um, and yeah, so again, hey, again, like Weibo, like it's you can go to Wall Street Journal and you can do the same thing. Like you don't have Cap IQ, go to Wall Street Journal. Don't need an account to look up a company, and they'll provide their financials. You can go to Yahoo Finance. You can go to the company's 10K, 20F filings themselves to see these things. Hey, do your own like do this exercise on Weibo also, or do it on Google, do it on Snapchat, do it on Activision Blizzard, right? And just you know come to your own conclusions and just practice it, right? Like it's just good to like understand how things flow into one another and just like build that mental competency when it comes to reading these things. And you know, so anyways, thank you for watching. Again, it's to summarize, not assets are created equal, and so to the degree that you should probably shouldn't take some numbers like book value at face value, and I just run like uh, confidence. Just dig into it yourself, verify, come to your own relative number, discount as you wish, um, and and also book value in and of itself isn't necessarily the most indicative of of if something is a good investment or not. And that's the other thing. I'm not getting into like the investment lens. I just looking at pretty factual, just like the accounting basis. But again, like you're not liquidating at this price because presumably, like the equity value, the management thinks the equity value has some upside. So again, not so much an investment thing. As with this video's focus, as is just like looking, spending a Sunday looking at a balance sheet, looking at a balance sheet, seeing what the components are. So hopefully you can remember what the accounting formula is. Maybe you can remember enterprise value and those good things. But thank you for watching. Hopefully you've learned something. Again, Cap IQ. Maybe maybe we could pretend that we are people at hedge fund analysts who have Cap IQ access. So maybe I'll have to pull up a Bloomberg terminal one of these days and pretend I know what I'm doing with shortcuts. But well, thank you for watching. Of course, as I should always mention at the end of these streams, if you learned anything, if you learned anything interesting, if you laughed at anything, if maybe you buy a company that decides to liquidate itself, maybe you buy uh, Inca Limited for 16 cents, and for whatever reason the company liquidates and you get 20 cents in cash. You know, that's a bad example because there's a $1 minimum. I guess. Uh, Good example. We'll pick on Joy. So you buy Joy for 25 bucks, you get 39 bucks back. Maybe you want to give a proceed, maybe because you figure out that arbitrage. Again, not saying that book value is that useful as an arbitrage figure, but maybe hey, buy me a coffee or two. 100 coffees, 1,000 coffees. But yeah, again, like I said, the Ko-fi again. I said it before, but like just claim a URL, claim a domain name. Just claim it. Can't hurt you. And again, for my Ko-fi at least, uh, post some Valorant postmortems of my good matches, and also then like interesting graphs and business related images. It's like the two things I'm probably gonna post to Ko-fi. Um, that's my Ko-fi. Of course, in the description. Check it out. Um, these will not be in the description. I don't. It's read only, so it's not that useful as an Excel in the first place. Again, like it would have been much more interesting, I think, if I had like a side calculation going on uh, to be more specific with the book value or the asset value. Um, just limitation of using a guest page. But again, hopefully you learned something, and of course check out the Ko-fi. And hey, let me know in the comments. Let me know again. Like I'm happy to look at if there's a company that you want that you think would be interesting to look at the balance sheet. Let me know in the comments. Be more than happy to look at companies that you guys think are interesting or want to look at the balance sheet, have a different view. Like have a different view. Like you play EA video games, you like to talk trash about EA and microtransactions and FIFA Ultimate Team packs. Hey, let's look at EA's balance sheet. I'm happy to do so. And again, I think especially for like gaming companies, like looking at the balance sheet of a gaming company, I think would be, or the financial statements in general, but certainly the balance sheet and like the way, uh, like the accounts receivable work for gaming companies, I think will be very interesting, and really interesting as a different perspective. Uh, but hey, let me know if you guys would want to do that. So thank you for watching and sticking around for 50 minutes. You know, again, definitely like hey, check out the Ko-fi. In the comments, let me know if there's any other companies that you think would be cool to look at a balance sheet of. So thank you for watching. Again, again, if anything, just remember the accounting formula: assets equals liability and plus shareholder equity. But thank you for watching. Continue to be safe.